Aloha, welcome to our next lesson, and we are on chapter 11, which talks about, well, the title of the chapter is Reporting and Interpreting Stockholders' Equity, and in a word, the topic of this chapter is corporations. Probably one of the most challenging topics in Accounting 201. But let's give it a whirl here. Let's talk a little bit about corporations and some of the advantages of the corporate form of doing business. We talked about the various forms of doing business in an earlier lesson. Basically, if you want to go into business, you can elect to be a sole proprietorship, and that form of business is owned by one person, just one person. You can also elect to do business as a partnership. A partnership is much like a sole proprietorship, except the big difference with a partnership is that it includes two or more owners. And then there's the corporate form of doing business. Corporations are an interesting legal entity. They're generally considered to be a legal person. There are a lot of advantages that go along with that status. In Hawaii, a corporation can have as few as one shareholder. And of course, when we start talking about publicly traded corporations, there are huge corporations. Walmart would be one example of a large, very large publicly traded corporation. You can have literally millions of shareholders who are the owners of a corporation. So the corporate form of business, of doing business, is very popular and offers a lot of advantages to the owners. Some of those advantages, the ones that are highlighted in the text, include the fact that shares of stock is the evidence of ownership in a corporation. Basically, it's a piece of paper that says that that is evidence of ownership in a corporation. Stock can be bought and sold in relatively small increments, so you don't have to buy the whole corporation at once. You can buy a very small percentage, or you can buy any percentage of a corporation that you are able to and willing to buy. And so along with that goes easy transferability of ownership rights. Not so much in small privately held corporations. For instance, family corporations, the stock would generally not be available for purchase by anyone outside of the group. For instance, if it's a family corporation, the stock would basically reside within the family and belong to those family members. But for a publicly held corporation like Walmart, shares of stock can be bought and sold on the stock market daily. So that's a big advantage for the corporate form of doing business. And another big advantage is that stockholders, the owners of a corporation, are not personally liable for the corporation's debts. So an individual who is a shareholder in a corporation, that individual's total amount at risk of loss would be the amount that that individual has invested into the corporation. There's a short discussion on pages 507 and 508 on debt versus equity financing. If you recall, in the previous chapter lesson, we talked about bonds. Bonds are long-term debt, or represent long-term debt. And so in a large corporation, to acquire funds or resources through debt financing, large corporations would generally issue bonds or sell bonds on the market. Another option for the large corporation is to issue or sell stock on the market. So that decision is oftentimes an important decision that must be made in larger corporations seeking large amounts of resources or money to do whatever it's planning to do, let's say expansion. Are you going to sell stock in the corporation, which represents ownership interest in the corporation, or are you going to sell bonds, which represents debt to the corporation? So some of the points discussed in the text include under equity or stock financing. Equity financing need not be repaid. So for all intents and purposes, if the corporation sells stock, that money that comes into the corporation, that capital that is transferred to the corporation by those stockholders, is permanent equity financing for the corporation. On the other hand, if the company goes the route of selling bonds or issuing debt instruments, then of course debt, like any loan, must be repaid to those individuals who are making the loans to the corporation. Going back to equity or stock financing, dividends, which are payments of profits that the corporation earns over time, payments to owners are called dividends. For common stock in a corporation, dividends are optional. The board of directors of a corporation is the body that makes the decision as to whether dividends are paid or not. On the other hand, with debt financing, again, like any loan that the corporation is taking out, interest must be paid on that loan. So there's no option not to pay interest with debt or bond financing. So dividends are optional, interest payments must be made. And another important point on the decision as to whether a corporation will do debt versus equity financing. With equity financing, anytime additional shares of stock are sold on the market, there may be existing shareholders that are purchasing new shares, or there may be new shareholders that are purchasing new shares of stock in the corporation. Anytime shares are sold in the market, there's the possibility that ownership control may become diluted. So an individual or a group of individuals with a relatively large percentage of the stock of a corporation, and so because of that, they may have voting control of the corporation, may very well find themselves in a situation where that control may become diluted based on the additional shares that are being sold in the market. If we go over to the debt side, debt is debt, and so there's no ownership involved. So the issuance of additional debt financing or the issuance of any kind of bond financing does not affect ownership control in any way. So those are some of the highlights of some of the discussion that takes place in the chapter relative to the advantages of the corporate form of doing business, and also the decision that the corporation has relative to debt versus equity financing. And we'll come back to another lesson shortly on the same or related topics. Thank you.